Welcome back to the Inorganic Podcast. My name's Christian Hassold. I'm your host, and this is episode 20. In this episode, we are going to explore a take private transaction. This is going to be nerding out. I just want to give you an alert. It's going to go a little longer than usual, but it is a super interesting topic that's going to go a little bit deep into like the how things work. And the reason why I want to do this is there's been a lot of take privates this year. And one of them that was just recently announced was the take private of Smartsheet by Blackstone and Vista Equity for $8.9 billion at around a 7x multiple. And it's just one of those transactions where it's like, okay, Smartsheet's a great product. It's a great company. Why is it going private? How does that work? What's the impact on employees? How do the investors make money? What's the process look like? We're going to explore that in this episode. And the best way to learn about how these things work is to bring in a subject matter expert. And I'm very grateful to have with me on the podcast, Erik Morton, who has substantial experience in M&A and a little bit of experience in take private. Erik, welcome to the Inorganic Podcast.
Thanks for having me. I'm happy to be back.
So Erik, maybe we should start by just walking through a bit of your background. You probably won't call yourself an expert, but you are a very well-experienced M&A practitioner, and you've been around take private transactions and a lot of what we would call creative transactions, working with PE sponsor type investors. So if you could just share your background with that, highlighting that perspective, that would be great.
Definitely not an expert. I like to think of myself as a jack of some trades in the software and corp dev world, master of none, if you will, but have had some experience in this space and a real privilege of working on some interesting transactions in my role as SVP of strategy at what is now called Rhythm, but used to be called Commerce Hub. So I have worked on take privates both from the sell side perspective, as you would call it, when Commerce Hub was taken private by two PE firms in 2018. And then also on the buy side, when Commerce Hub took Channel Advisor private in 2022. So it is by no means encyclopedic expertise, but it is, I think, a view of a operator and an insider within a software business.
Cool. Thank you for that background. It's super helpful. And for my listeners, I just want to level set with you that take private transactions, there are investors, there are people who really know well how this stuff works, but there's a ton of companies between 150, 300, 500 million in revenue that are public and for various reasons probably should be considering a take private, but the process is not so easy. One, there's a lot of investors who just don't want to deal with take private because they're costly. Invariably, there are lawsuits. There's just a lot of legal and regulation around take privates. And two, take privates are just very complicated and very time intensive. These are not transactions that close in 90 days. They're transactions that usually take 6 months and for various reasons may be subject to regulatory approval, shareholder approvals, other processes. So they're quite complex beasts. So I'm really excited to explore this in a way that is accessible to this audience. I think in the spirit of that, where we should start, Erik, is maybe just walking through like what is a take private transaction? What does that mean? And why would a software company need to explore a take private? So maybe you can start with what this actually is.
Absolutely. It's helpful sometimes to think about it from the perspective of the life cycle of a business, where we all know a company is founded. Maybe a software business raises some venture capital. They spend a lot of money on R&D. They spend a lot of money in sales and marketing. They acquire customers. They get to that breakout velocity of sales growth. Maybe they're at least $100 million, $200 million in revenue. And then they reach the promised land. They get to go public in an IPO. They get to ring the bell on the New York Stock Exchange or press the button at NASDAQ. And a lot of people view that as the end of the story. And the reality is it's not the end. You're just transitioning into the next phase of that company's life cycle, which is now you are a public company. Instead of just having a bunch of venture capitalists on your board and owners of your equity. Now your equity is owned by potentially hundreds or thousands of institutions and individuals. You are now subject to all sorts of fund regulations from the SEC here in the United States. You have to report earnings, and it is a very, very different way of running and operating a business. And the thing that I think is interesting about that is that software businesses specifically are still viewed, for the most part, as growth businesses. There's a sense that the SaaS market is still a secular growth market, and investors want certain things and expect certain things from public software companies. And one of those things is growth. They value companies still primarily based on their revenue growth. That's great if your revenue growth is 20% or more. But if you are a business that is potentially reaching more of a plateau, maybe your TAM is not as big as you thought it was, maybe you've got more competition from different sectors of software, maybe you're worried about AI or something like that, and your growth starts to slow, then it becomes more of a dynamic where the board will start to wonder, does it make sense for the board to explore, as they would always call it, strategic options, which is almost always a take private kind of transaction where the board will hire an investment bank, and they will most of the time run a competitive process and have private equity firms, financial sponsors, and then potentially other software businesses or strategics participate in that process. And that process is similar to a private company buying another private company. You've got the data rooms, you've got the letters of intent, you've got due diligence. And if you want, we can certainly talk about the differences and similarities there. But eventually, it's going to result in a negotiated stock purchase agreement of some kind that is publicly announced, very awkwardly, honestly, because the deal isn't closed yet, to everybody, where the company will be taken private by, for example, a financial sponsor, which means the financial sponsor is committing to acquire all of the publicly traded shares of that business. And when the transaction closes, there's no more publicly traded shares. The company's shares are delisted from NASDAQ or NYSE, and the company is then owned by the acquiring financial sponsor.
That's a great overview. There's a lot of detail and questions born out of the explanation you provided. So we'll dig into that in a little bit. I think one question you might all be asking, which is, why are we talking about Smartsheets? Well, one, it's a very relevant recent transaction. It's also working out to be one of the largest take privates of 2024. Adventia is a $13 billion take private. Smartsheet is going to be $8.9 billion. Squarespace is $6.9 billion. There's a few others that are at or around 5 and below. So this is a very material size take private transaction occurring for, I think, some of the reasons that Erik mentioned. I don't know the exact reasons why, Smartsheets is where it is. I think we all know it as a great tech platform, software platform. But I think one thing we know about Smartsheets, similar to Excel, is these products tend to be substitutes for a lot of things. If you're in the software business, frequently what happens is you find that Sheets or Excel are substitutes for one another. And what would be a substitute for Smartsheets? Well, we're in a world where there's Airtable, there's Basecamp, there's Asana, there's like tons of up and coming SaaS platforms that have created lookalike capabilities, and Smartsheets has some capabilities that I think are unique to it, but there's a lot of like-kind competitors. And so I think the TAM has gotten crowded, the market's gotten crowded, and that may be one of the reasons why Smartsheets made sense for them to go through a take private. So just a little bit of context there. What's your thought on maybe why specifically Smartsheets might explore a take private from your perspective, Erik?
I'll speculate here a little bit, and it is influenced right now by my view of the SaaS industry in general, which, as we all know, has kind of been viewed as a secular growth story. I really do think that that's changing now. If you look at the second quarter of this year, only about 15 of 70 or so public SaaS companies actually reported accelerating revenue growth. So the story is really changing, and a lot of the growth within these businesses is declining. And if you're a board, your responsibility is obviously to maximize the value of the business for all shareholders. And you know that there is it's essentially hundreds of billions of dollars of dry powder out there at financial sponsors that want to take businesses like this private. And we could talk about what some of those reasons are. I think the summary is usually related to the recurring revenue of these SaaS businesses is very appealing to financial sponsors. And there's also a lot of opportunity usually to create value through cost cutting. And that's not something that most public SaaS companies do. As we talked about before, they tend to be focused on talking about revenue growth and telling a story of being a growth stock. It's hard to then say to public investors that you're going to go and reduce costs by 20% or so. That breaks the narrative of how a public software investor would be valuing a business. So that kind of value creation tends to happen within the private market. So if you're a public board, just to be clear, Smartsheet has had a really incredible run. Like, it's been a great story. They went public in 2018. And over the course of the last 6 years, I think it's about a 18% annualized return for the Smartsheet stock, which exceeds the S&P for that time period. So it's been a good publicly traded stock. So if you're a board, you want to be mindful of not losing an opportunity to potentially sell a business at a fair and reasonable price to a financial sponsor. So we're speculating a little bit. Obviously, we haven't read the full proxy rundown. Yeah. But that's, usually how those conversations will happen in the boardroom.
Yeah. I mean, look, a public company has fundamentally two audiences. Well, three. It's got the analysts, it has the institutional investors themselves, and it has retail traders. And, each one of them has different sort of motivations and how they make investment decisions. But, one thing that they like to hear is what's exciting, what's growing, what's next, how are you going to maintain CAGR of more than 20% year over year? And that gets hard to do as you get larger as a company. And you're right on that. It's $8.9 billion private exit says something about the quality of the underlying business. So by no means are we throwing any shade at this transaction, really more just trying to understand what actually goes into it. And I think another point that you raised, if you talk about generally where we are, a lot of companies experienced COVID tailwinds in terms of growth, unexpected growth, and coming out of that, they are consequently experiencing COVID headwinds, which is the growth that we had, the 25, 30% growth we had in 21 and 22 is now coming down because a lot of spending happened and CFOs and boards said, hey, let's cool it off a little bit. We're going to make it a little bit harder for us to spend money. And that has had an impact on a lot of software. If you follow Jim and Ball's Clouded Judgment blog, there's there's a sea of very credible companies, Palantir, CrowdStrike, Cloudflare, ServiceNow, all who have been challenged by these headwinds. So no surprise that this is replicated throughout the rest of the market. So I think kind of understanding a little bit more about how this transaction work would be a good logical next place to go. So maybe we should talk a little bit about the transaction itself. It's interesting that Vista and Blackstone are going in together. And I'd love your perspective on this, Erik, because Vista is known to have playbooks. They buy a company, and if you're an executive in that company, you know one thing, you are running from a playbook that is prescribed. This is what we expect from leadership. The psychological batteries have been applied. Everyone's going to operate and behave in a particular way. And this is how Vista creates value. Blackstone, I know a little bit less about. I mean, they're a major player, but I don't know them to exactly work the same way. Maybe they're like a co-sponsor of the transaction and Vista is going to be running the show. What's your read of the cards of how it works when you have these two material kind of investors come to the table? What's your theory?
There's been more talk about the idea of sponsor syndicates, and this one is interesting because the lead is Vista. And to your point, they've done many take privates and have a long, long history in the software industry, combined with Blackstone. And Blackstone is more of a traditional leveraged buyout shop. So they'll be buying industrial companies. They do all sorts of different kinds of transactions. And interestingly, this one, if you actually read the SEC filings, it includes a third sponsor, which is the Abu Dhabi Investment Authority. So this is a sovereign wealth fund that is participating in it as well. And my view on this, and again, I'm not an expert, is that because these software businesses have grown significantly, you need to write bigger checks. And the equity check in this transaction is approximately $4.5 billion. And I don't know the specific fund that Vista is using to acquire Smartsheet, but that's a pretty big check within a single fund. So if you think about the risk management perspective for a PE sponsor, they don't want to commit too much capital in a single fund to a single deal. So having another sponsor that can come in and write an equity check just helps all the sponsors effectively participate in larger software deals.
And the other thing is sort of what is you were just mentioning earlier, sort of the equity check. So it's $8.9 billion, but it's not all cash. There's cash and there's debt. And I believe some of the work you had shared before the episode, you calculate that this is about a 7x EBITDA multiple transaction on forward-looking revenues. Is that the way you read it?
That's right. So if you read the press release, it leads with the idea of an $8.4 billion equity value. Mm-hmm. And when you finance a transaction like this, you're not financing the equity value. You're thinking about it from an enterprise value perspective. And the reason why you would do that is public transactions, these take privates, are a little bit different than a private to private transaction that many people might be a little bit more familiar with, where in a private to private transaction, you tend to do the deal cash-free, debt-free. So when you acquire a business, and let's say a private company is acquiring another private company and the target has $20 million in cash in their bank account, the acquiring company, when they acquire it, they don't necessarily get that $20 million in cash. They might just get the working capital. Very different in a public company environment, where in a take private, Smartsheet had, I believe, $700 million or so in cash or cash equivalents. And the private equity firms will inherit that cash and use that cash to finance the transaction. So you would think about it on an enterprise value perspective, which back of the napkin, I think is about $7.6 billion enterprise value. And as we all know, software businesses tend to be valued on a forward revenue growth, forward revenue multiple perspective, and current consensus estimates from the public analysts that cover Smartsheet is that they'll do about $1.1 billion in revenue over the next 12 months. And that's how you kind of get to a 7x multiple on the business on an enterprise value basis.
You know, there's a lot of companies out there that are trading well, but their enterprise value is trading at or well below the annual revenues or the reasonable multiples of those businesses. And so there's if you're a little bit less educated, you might say, wow, that's a great deal. Why don't we just go buy that company? There are a lot of lawyers who are waiting in the hallways for these take private transactions. And no matter how much you do to prepare for these transactions, you will be sued. And so maybe I think one other thing we should point out here is that when you're doing a take private transaction, if you really want it to be successful, if you want it to land, you have to have like a fairness opinion. You also have to have a little bit of a premium there to make sure that the most material investors are fully satisfied that the value of the enterprise is reflected in the purchase price. And I know that you've been around this whole fairness opinion and kind of process. So like being around that, how does it really work?
Process matters a lot. So if you think about the board of directors, obviously they have fiduciary duty. They need to ensure that it is a fair price for the business, all sorts of other requirements and duties as well around like equitable treatment of all of the shareholders. And it is definitely an issue with a company like Smartsheet, which from the perspective of IPO through take private price, it's a pretty nice run. As I mentioned, it's like 18% annualized returns. However, Smartsheet, like many other software businesses in 2021, was trading at a much, much higher value. So I believe Smartsheet stock got up to like $84 in 2021. So if you think about it from the perspective of the retail investor or even the institution that buys it in 2021 at $84, and now they're essentially they'll be forced to sell it at $56 or so. It's very, very important that the board runs a process where they're saying this is the right time for us to sell, and here's why. So, for example, we talked about declining growth, competitive dynamics within the industry, interested buyers. And then they also want to show that they went through a process that led to a fair price, that they were able to essentially maximize the value of the business through a fair process. And that's why you tend to see formal auctions that are run by investment banking firms, credible investment banking firms, you know, all the names that we're familiar with, where they go out and they talk to dozens of financial sponsors. They'll talk to other software businesses and they'll pitch it and they'll get bids, and the board will see that a fair process was run. These are the bids that came in, and they're able to then defend that and document that through the fairness opinion so that shareholders see it was the right time to sell the business, the right process was followed by the board, and that led to a transaction that the board is highly confident will close. And that's why shareholders would be asked to approve it. And if they do, then the transaction closes.
So that color on that process makes a lot of sense. I think maybe the more practical question I have is, like, let's say you're the corp dev guy, and for someone who wants to acquire a public company, and that public company has not yet initiated a process, like what is the first step, right? You can't just go meet the CEO and say, hey, I want to buy your company, right? You've got to actually follow some steps in order to initiate the process and the conversation. So in a scenario where the the public company is not actively in a process, but you believe that for some reason it's something they should be exploring, what are the 2 or 3 things you need to do before you actually go to the company and express interest formally?
In general, these deals can actually start in a similar way that a private to private deal would happen, where you would expect the CEO is out there, they're talking to other market participants, and they're also maintaining relationships with financial sponsors, just as normal course. And if you are another company that wants to potentially take a public company private, then getting prepared, honestly, is going to be similar, where you want to make sure you have your deal team in place. You've got executive alignment on that as well. And most importantly, in a take private, you will definitely want to have a formal financial advisor in place. You're likely going to want another investment bank that is representing you. And one of the reasons why that's so helpful is that the financial advisor serving the buyer is able to have, call it more informed conversations with the advisor representing the seller on boardroom dynamics in terms of what really is happening within the boardroom at the seller. Do they feel like the process is going to result in, is it going to be a fair process, and is it going to be a fair price for the business? And the reality is that you have a similar dynamic with private companies, where you might go and socialize to the CEO that you're interested in pursuing a transaction. You might talk a little bit about how you're thinking about value, just to kind of test the waters a little bit. They'll start then lining up advisors on their own side, because what tends to happen is you'll have the famous inbound interest from a potential buyer that can then lead to a formal auction process, where the potential seller will then hire the investment bank, and the investment bank will run a formal process, and the initial party that expressed interest in taking the company private will just be another participant in that process along with everyone else. What's more interesting is a dynamic where you don't have that full auction, where instead you have a one-to-one negotiation that can lead to a negotiated and publicly announced transaction. Now, we could talk about different ways you speculate this, but the Smartsheet deal is interesting because what they've filed so far, normally when you would sign a letter of intent to acquire a company, as you know, you might have a no shop where the buyer and the seller agree that the seller will essentially give that buyer exclusivity for some period of time. And you don't have that in the Smartsheet deal. You have the exact opposite. You have something called a go shop, where Smartsheet has the ability to, for whatever it is, 30 to 45 days, solicit additional bids for the company. And the reason why you would do something like this is you might have a board that is concerned that they might be a perception from maybe an aggrieved shareholder that they didn't really do enough to maximize the value of the business. So they negotiated a period of time where Smartsheet could actually solicit additional bids from alternate parties.
This is the point I was raising earlier. There are lawyers waiting for you to make a mistake. So if you do that one-to-one transaction, you need to make sure that that one-to-one transaction, if it's going to be a no shop, is going to be something that is going to get the right reaction from your material investors. And if you're a smart CEO, you're going to channel check the temperature for these kinds of things. But doing a shop actually ensures success and reduces the likelihood of the lawsuits are going to come, but those lawsuits' ability to stand to have standing is going to be based on, how you ran that process. I think one thing you're getting into here is kind of who needs to be at the table. And you mentioned that if you're the buyer, you want a banker representing you on the buy side. But there are other people who need to be at the table, and there are other things you need to do. Maybe you could talk about who are the other advisors that need to be involved in a take private transaction, because if you're taking a public company private, there's a lot of other things to happen. So what do those other advisors look like?
From the buy side, in the case where the acquiring financial sponsor, or maybe, and this was my experience, where we were a strategic, but we were a strategic that was owned by private equity firms. And your advisors will be similar to the advisors that the PE firm would normally engage in any kind of transaction. So as a corp dev person, you can kind of think about this as the process that you'll run internally within the buyer is similar to any large significant transaction that needs to pass the various investment committees at your financial sponsors. So in large transactions, and here we're talking 8.4 billion equity value, that's a large transaction. But even in, a couple $100 million transactions, it's very frequent to have a quality of earnings engagement where you're working with a Big Four accounting firm to understand what that true normalized pro forma performance of the target business is. And then you're probably also going to work with a Bain consulting firm, someone like that can kind of do a market study, get more confidence around addressable market. Because the real purpose here as a buyer is to ensure that you'll be able to get through the sponsor's investment committee and understand what is that pro forma financial plan that they're underwriting, which is going to be some combination of what is the revenue growth we think we'll experience, and then what is the cost structure that we think we can have for this business as a private entity. So at a high level, you've got consultants kind of helping you provide third-party, credible sourcing and analysis around that financial plan that will be essentially what the investment committee at your sponsor will be asked to underwrite.
Yeah. Now, we talked about the advisors, but we also talk about sort of what we haven't talked about is what the potential acquirer can and cannot do during the process. As an example, can I, as the potential acquirer, go and ask for coffee meetings with employees of the company because I want to learn about which management I want to keep or not, or what are like the other opportunities for, improving the economics of the company? Sort of tactically, what are the things you can and cannot do?
In these transactions, you tend to have a pretty small group of people on the buy side and the sell side who are even aware of the transaction as you would expect. So you naturally have fewer people that would be engaging and interacting with each other. But at the same time, you could have a buyer and a seller that are partners and have normal course of business interaction with each other at different levels of the organization who are more than likely not aware of the transaction at all. What I think tends to be a little bit more interesting is what happens after you negotiate the transaction, you sign the merger agreement, you publicly announce to shareholders that this transaction is going to need to be approved by shareholders and will could close in 90 to 120 days is what happens then. Because one of the regulatory dynamics in SaaS that's pretty simple, thankfully, like SaaS companies are not heavily regulated businesses, but they're subject to regulations in the Hart-Scott-Rodino Act, or HSR. So any large transactions kind of have to pass muster at real basic, monopoly and competition kind of perspectives. And there's all sorts of regulations around the idea of not running afoul of that. And you can do some amount of interactions between the buyer and the seller. So for example, you can bring the management teams together before you close the transaction. You can talk about each business. So for example, if a strategic is taking a software business private, they announce the transaction, the management teams can get together and they can each talk about their business. They can actually disclose non-public information as well within that context. But what they can't do is make any decisions about how to run the business in the future, because that is viewed by the FTC as essentially gun jumping the HSR review, where you're kind of already acting as a combined business, even though you have not received your clearance from the regulators.
Yeah. But like the example I was kind of posing there, which is in a scenario where you're already doing business together, it's easy for legitimate reasons to be engaging, to have normal course conversations, a coffee talk, if you will. But in a scenario where those relationships don't really exist, you as the acquirer are kind of bound to, maintain a decorum during the process. One, you don't want to tip the hand to people about what's going on. And two, you have to draw kind of a line around, as the seller, you want to draw a line around how much interaction there's going to be between the buyer and seller in the event that the deal doesn't go through. It can create a lot of complication if too many people get involved, or if too many people are read in, the rumors spread, and then you have other problems.
Absolutely. And what is so interesting about these take privates is that they have to be announced publicly before the deal closes.
Yeah.
And that becomes even more of a dynamic that you're describing, where you're telling potentially thousands of employees that this deal might happen, but it hasn't actually closed yet. And one of the interesting things about take privates is that the company that is going private has to file at the SEC information that they've communicated to employees about the transaction. So you can go through the public filings and see the email that the CEO sent to employees when the deal was announced. You can see the FAQ that they put together for employees, and it will always include comments around, hey, don't go on social media and talk about this yet. And if it's a strategic that's taking them private, it's like, hey, unless it's normal course, like, don't reach out to employees of the company. And it's all just about risk mitigation. It's
a lot of additional sort of process and work. You really have to have things buttoned up when you're running this kind of transaction. One of the things is if you're in a public company and you have your stock grant, the stock grant is now yours. You're sitting on $100,000 in public company stock. That's cash you can do something with. In a private company, if you have $100,000 in stock grants, like, you're just staring at paper. You have to wait for that thing to become liquid and do something with it. So going from public to private is sort of some material differences in what that means to employees. In a take private transaction, how do employees win, and what are the things that become different for them?
It's a completely different world in a take private transaction. When you are an employee of a publicly traded SaaS company, all these companies kind of do the same thing, where they work with compensation consultants and they put together a equity compensation program. Has to be approved by shareholders, and it will result in the granting of restricted stock units, RSUs for the most part, stock options for the more senior executives, to employees on a regular basis. And many SaaS businesses are notorious for highly dilutive stock-based compensation programs, and Smartsheet is no exception there. Over the last couple quarters, Smartsheet has issued more stock, so more RSUs than their revenue growth. And once this dynamic starts to happen, it's kind of sort of one of the things that influences whether a take private transaction is appropriate, because you've got a dynamic where employees kind of expect that there'll be this ongoing annual granting of RSUs. And what that would look like For example, is maybe you've got an employee that receives on an annual basis $100,000 grant of RSUs. For example, they could vest 25% per year. As those RSUs vest, what most employees will do is they'll just sell the stock. That means public company investors need to acquire that stock, and that dilutes the overall ownership of public shareholders. So what happens usually in a take private is that once that business goes private, all of those public shares are acquired by the acquiring financial sponsor, and the financial sponsor will roll out a very, very different equity incentive program. They can look different in many different kinds of sponsors. The usual design that you'll see is related to the overall capital structure of a private company, where you've got preferred stock that is owned by the financial sponsors, and then you've got common stock, essentially. And a portion of that common stock is allocated to employees, could be between 10 to 20% usually. But to your point from before, there's no liquid market for it usually, which means even though it's vesting, it's just paper that you're looking at, and it doesn't actually convert to cash until you have the next change of control transaction, which could be 3 to 5 years down the line, when maybe Vista and Blackstone decide that they're going to sell Smartsheet to another financial sponsor or a strategic.
Yeah, so I think kind of the short form of what you're articulating is, aside from the kind of liquidity differences of the equity, and then going into the sort of the process of how do employees kind of get benefit from the private transaction. I think some of the mechanisms that I've seen happen are, number one, you want to retain keys in terms of management plus second line management, who are critical to the success of not just the deal, but the integration process. So you're going to structure cash incentives, cash bonuses, and probably releases of stock that granting of stock, and the actual awarding process associated with milestones that occur through the closing and the integration process, which can be anywhere from 6 to 12 months, depending. So one thing I have noticed, and I wonder if this is kind of your experience, is that while the nice thing about public markets is your equity is basically liquid, and usually companies that are run well are going to have decent stock incentive programs for employees. Private equity companies perfectly understand the desire and interest for people to want to make money, so they tend to be pretty good at cash bonuses, and annual compensation plans that have reasonable bonus structures built within them based on your own performance and the company's performance. And comparing that with working for, say, a venture-backed SaaS company, there's usually, I think, a little bit of a better experience. And like, if I were to rank sort of incentive programs from like the worst to the absolute best, SaaS companies, equity incentive programs and bonus programs are usually optimized towards growing the company versus incenting the people. And that stock usually takes a long time to become liquid. PE investors are a little bit better at understanding motivations of people and making sure that they're well compensated for the work that they're doing and they're incented for performing. And public companies are probably the absolute best, because not only do you have the cash compensation in your variable, your salary and your bonus structure, you also have liquid public stock as an incentive. So I think maybe just kind of explaining those differences at a very high level and kind of tactically how they play out is interesting for the listeners to hear.
In a public SaaS company, I think you'll definitely have a similar dynamic where a lot of the incentives are really based on the issuance of the RSUs. And you probably do have a cash bonus component, but it might be a little less well thought out, because it's just easier for a lot of these SaaS businesses to kind of focus. You also have employees that are expecting more of a focus on RSU issuance. Now, what's nice in a take private transaction when you are selling to a private equity firm is you have a built-in retention bonus program in the form of all of the unvested RSUs that are outstanding at the time of the transaction. What frequently will happen is that those outstanding RSUs that are unvested will convert to cash awards that are paid out to employees on the same vesting schedule. So built in, you've got a dynamic where employees are already kind of sort of focused on the idea of staying with the business because in their heads, they were already counting on all of that unvested equity to vest and they were going to sell it. So what the PE firm will do is they will pay out those awards at the take private price, $56.50 or so for Smartsheet on that same vesting schedule. And it's built into the transaction, essentially.
Yeah, perfect. It makes sense. So just kind of taking us to where we are, we've talked about, why these transactions happen, what the process looks like, who are the players involved. We talk about the pros and the cons, the benefits for employees. I think the one thing we didn't talk about is if you're Blackstone, if you're Vista, if you're the Abu Dhabi fund, how are you going to make money on this deal? And so I think the right place to land here is, Erik, you created a really great breakdown. I'm just going to share here on the screen that we can all see. Is like, walk us through your hypothetical exit waterfall of like how you see this working out for the investors. How do they make money?
The reality in deals like this is that there is almost always, to start, a very significant cost cut that the sponsor will work through initially. And the way you would kind of think about that is you always have to look at the new capital structure of the business. And in the case of Smartsheet, we have about a $7.6 billion enterprise value, which is roughly split as $3.2 billion in debt financing and then $4.5 billion in equity. So it's roughly 40% debt, 60% equity. And that's, kind of normal in these kinds of transactions. So the first thing you do is you have to look at what are the debt servicing costs for $3.2 billion. And there's already some information that's been, published online on what this debt looks like. And the way it's structured is that it's almost always structured as a spread above SOFR, which, if you're not familiar with that, it's like the new LIBOR. It's like the short-term base rate, if you will. And then depending on the risks of the deal, the company will be paying a spread above that. And approximately right now, that might look like a 4.8% SOFR. And the spread I read online on this debt is going to be about 6.5 percentage points. So they're going to be paying around 11%, call it, interest rate on the $3.2 billion in debt. So the annual servicing on this is about $360 million or so. So to put that in context, forward estimates for Smartsheet's EBITDA over the next 12 months was about $200 million. And let's just assume that that's all cash flow at this point. So you're already in a situation where the debt that they're using to finance this deal is considerably more than the cash flow that the business is already generating. So that kind of gives you a hint that there's going to be a pretty significant cost restructuring where they'll have to take cost out of the business in order to service the debt. So already, all else equal, you would have a business with higher margins. And what you would tend to see in a deal like this, what I would expect is that the financial sponsors are probably looking to simply, their game plan is as simple as maintain the current revenue growth rate at a higher margin. So they're not even looking to like accelerate revenue growth necessarily.
Yeah.
I believe the forward estimates on revenue growth for Smartsheet are about like 7.5% or so. So if they can have a 7.5% revenue growth business with higher margins. So think like 30 to 40% margins. They run that business for 3 to 5 years. That business could be worth on exit. Their underwriting would be at least the same multiple that they paid to take the business private. So at least they think it would be worth 7x revenue. And they're probably thinking, even if they wouldn't underwrite it necessarily, that it could actually have a higher multiple. So maybe it's going to be a 10x multiple or so, as I have on this little, scratch sheet here, which means if they grow revenue to 1.5 billion in revenue within 5 years, you put a 10x multiple on that, you've got a $14.7 billion business. You still have that $3.2 billion in debt. So you've got equity value of $11.5 billion. Back of the napkin is like, it's about a 21% IRR, 2.6 multiple on invested capital. That's a good outcome in all cases. It's like, is it a grand slam? I don't know. It depends on how the firms think about it, but that's a really good outcome. And it is very compelling from a sponsor equity perspective because they'll return the initial $4.5 billion in preferred capital. The way these preferred deals are usually structured is there's going to be a PIK of some kind of, 12 to 14% potentially. So I'm just assuming maybe there's another $4 billion or so in PIK, and that gives you $2.8 billion in common equity. And depending on the size of the management pool, here I just plugged in 10%. You've got a $285 million management pool that would essentially be paid out to the remaining employees through their equity incentive program. And for fun, obviously I have no inside information on this, but Smartsheet had been issuing about $200 million a year in stock-based compensation. So if you just assume maybe they would continue to issue $200 million a year in stock-based compensation over 5 years, that would be $1 billion worth of value that would have been granted to employees compared to in the private equity, back of the napkin, no inside information, around $285 million through a management pool. It's a very, very different kind of setup.
So Erik, look, this is a great conversation. We covered what does it take private? Why do companies go private? How the process works? How do employees make money? What's the difference in the compensation structures between public and private and even SaaS? And more importantly, how do the investors make money? And what are the things that have to happen inside a company for those investors to make money as a part of their underlying investment thesis? We covered a lot of great topics. So thank you so much, Erik, for being our expert witness on this episode.
It's been my pleasure. It's a lot of fun. Thank you.
And to all my listeners out there, I want to thank you for listening to this episode of Inorganic with Erik Morton. I know it was a little nerdy. It was a bit of a deep dive, but I hope it was super illuminating for you. If you enjoyed the conversation, please like, subscribe, share with your friends. Until next time, I'll see you on the next episode of the Inorganic Podcast.